children, welcome back to another video of mine. I hope you all have done your term exam very well. So let's begin with term 2 portions. Before I proceed with this chapter, I'd just like to tell you all that the recapitulation video for the chapter Rise of Nationalism in India has been already posted in this YouTube channel of mine. So just scroll down and you will get the important concept related to the chapter Rise in Nationalism in India. So now, shall we begin with the next economic chapter, Money and Credit? Now, what is meant by barter system? In simple language, it means exchange of goods for goods. Let's look at this picture. Here we can see a boy who has orange in his hand and a girl who has banana in her hand. The boy would love to have the banana and the girl would love to taste the orange. So they both decide to exchange the fruits which they have in their hand. So the boy will give his orange to the girl and the girl in return will give the banana. When such a action takes place or when such a situation takes place, it is called barter system. The next concept is double coincidence of one. This is a situation where a person is wishing to sell is exactly the same as the other person who is wishing to buy. What do you mean by that? Let's take this example. Here is a man who wants to sell his fruits and here is a boy who is ready to buy the fruit. So here the person is wishing to sell his fruit and there is another person who is ready to buy the fruit. In the same way, here let's take another example. Here is a person who wants to sell his chicken. And here is a man who wants to buy the chicken. So when such a situation takes place, this is called double coincidence of ones. But what is the disadvantage of barter system? First of all, it is very difficult to find a person who is ready to buy the goods you want and in turn get the goods which you are looking for. So that is the first disadvantage. Second one, no common measure of value. Third one, it is very difficult to store the goods. And last one, it is problem of future payment. In order to overcome the difficulties that arise out of the double coincidence of one, different forms of money came into picture. Before we look into the different forms of money, let's understand the term money. What is money? Money is anything which has a common acceptability as a mean of exchange, as a measure and a store of value. What were the different forms of money? Let's look into the ancient period. In the ancient period, grains and cattle were used as money. In the medieval period, with the discovery of metals, gold, silver, copper, etc. was used as money. In the modern period, paper currency, notes, coins, credit cards, ATM, internet banking, cryptocurrency, bitcoins, etc. are used as forms of money. Now, why is money accepted as a medium of exchange? Number one, goods and services are bought and sold with the use of money easily. Money solves the problem of double coincidence of ones. Money is something paid as advance with the promise of delivery of goods later. It is a perfect store of value. Last one, it makes economic activities quite independent from each other. What is a bank, children? A bank is a financial institution whose demand deposits are widely accepted as money for making payments and has the power to create money. Or in simple language, a bank is a financial institution where people can deposit money and take loans when they require. Now let's look into the different banks of India. Reserve Bank of India is the head of all the banks of India. Reserve Bank of India is further divided into commercial bank, cooperative bank and development bank. Commercial bank is further classified into nationalized bank and private bank. Nationalized banks means the banks which is owned by the government and a private bank which is owned by the private individual. Cooperative bank usually deals with short-term credits and long-term credits. The short-term credits are mostly concentrated in the agriculture sector and in the urban sector. Development banks helps in the development of the country and they usually give loans or deals with industries and agriculture. Now let's look into the type of deposit the bank has to offer. The bank has two types of deposit. One is a demand deposit, another one is the fixed deposit. What is meant by demand deposit, children? Deposit in the bank, which can be withdrawn on demand, is called demand deposit. And this can be further classified into three: current account, savings account, and a call deposit. Now, how can a person withdraw money from a savings account? Earlier, people used to use check to withdraw money from the savings account. But today, we have many other types of methods where we can withdraw money. We can go to the ATM and withdraw money. We can use internet banking facility and transfer money from one account to another. Or if you want to make any payments, we can use GPay, Google Pay, etc. So what exactly is a check? A check is an instrument instructing the bankers to pay a specific amount from the person's account to the person in whose name the check has been issued. Let me explain this with an example. Let's say Mr. John has an account with ICICI Bank and Mr. John has to pay 10,000 rupees to Mr. Sam. So Mr. John will issue a check in the name of Mr. Sam for the amount of 10,000 rupees, instructing the ICICI Bank to pay that amount to Sam when he presents the check for payment. This is called a check. I hope it is clear now. What is a fixed deposit? This is the second type of deposit which the bank has to offer. This is also called term deposit or time deposit. What do you mean by a fixed deposit? When a person deposits money with the bank for a certain period of time, let's say 2 years, 3 years, 5 years, etc. Then we can say he has a fixed deposit with the bank. The bank will definitely pay an interest for this deposit, which is much higher than the savings bank deposit. When a person opens a fixed deposit, the bank will give him a fixed deposit receipt. This receipt will consist of the name of the account holder, the amount he has deposited, the rate of interest, the period or the time period which the deposit will be with the bank, and last, the total amount which the customer will receive at the time of maturity. After the maturity date gets over, this amount will be automatically transferred to the savings account, or the person can withdraw the money with the help of a check. In case the depositor wants to withdraw this money before the due date, he can do it, but a penalty interest will be charged. Children, let's look how banks get their income. We all know that bank accepts money from the common man and in turn pays interest for the money deposited. We have seen that in the previous slide, and whether it's a savings account or the fixed deposit account, bank that accepts the money which we have deposited and in turn we get an interest. Number 2, the bank retains 15% of this deposit as provision to make payments to the depositor and also to meet the day-to-day expense. The remaining amount is given to the customer who is in need of money or who approaches the bank for a loan. An interest will be charged on the money which is given to the customer as loan. This interest will be much higher than the interest which the bank gives to a depositor who has a savings account or a fixed deposit amount. The difference between these two interests will be the income of the bank. Nowadays, banks also does many other services. They make payments on our behalf, such as paying the insurance, paying the children's fees, paying the rent if instructions are given by the customer. For this, they charge a service charge. This also adds as an income to the bank. Types of loans. We all know that banks not only accept deposit from the customers, but also they pay loans to the customers in case they require it. Now, what are the different types of loans that the banks can offer? First one is housing loan in case you are planning to buy a new house. Second one is a vehicle loan in case you are planning to buy a new car, scooty, etc. Then comes education loan where loan is given for higher studies or for children who is planning to go abroad for higher studies. Whatever type of loan the borrower takes from the bank, he has to pay the interest regularly. Next one is a debt trap. A debt trap is a situation when it becomes impossible for the borrower to repay the loan and the borrower adds on a new debt to pay the existing loan. Let me explain this with an example. Let's take Mr. Kumar. Mr. Kumar wants rupees 10,000 urgently. So he takes the loan from a money lender with the promise that he will pay back within a year. But after a year, due to some unforeseen circumstances, Mr. Kumar is not able to pay back that rupees 10,000. So what will Mr. Kumar do? In order to pay back that rupees 10,000, he will take another loan from his friend with the promise that he will pay back that loan within 6 months. So Mr. Kumar will approach his friend, take a loan from his friend, and that money he will pay the money lender. So the first loan is over. After 6 months, it is time for Mr. Kumar to repay the loan which he is taken from his friend. But again, due to some reasons, he is not in a position to pay back the money. But at the same time, he wants to keep up his promise. So what will Mr. Kumar do? He will approach his brother and take a third loan. And with that money, he will repay his friend. Mr. Kumar will continue doing this practice. And this will lead to a situation where everybody, his relatives, the money lenders, his friends, will not give him any more loan. So in such a situation, he won't be in a position to repay the loans which he has taken. This will automatically lead him to a debt trap, which is a very dangerous situation. Now, what is credit? A credit or a loan refers to an agreement in which the lender supplies the borrower with money goods or services in return for the promise of future repayment. Now, what are the terms of credit? Interest rate, collateral, documentation, and mode of payment. Now, what is a collateral? It is an asset owned by the borrower, such as land, building, vehicle, livestock, which is kept with the bank as a guarantee against a loan. This will remain with the bank till the borrower repays the loan. Once the borrower repays the loan, the collateral is handed back to the customer. Suppose the customer does not pay the loan, the bank will use this collateral and sell the collateral and may take the money which the borrower owns to the bank. Now let's look at the different types of loan. First, let's look at what is formal source of credit and informal source of credit. Formal source of credit is provided by the banks and cooperative society. The RBI supervises the functions of such source of credit. Proper terms of condition like collateral, documentation, rate of interest, and mode of payment are followed. The rate of interest is much less compared to informal source of credit. Now, what is informal source of credit? This credit is provided by the traders, money lenders, employers, relatives, friends, etc. There is no government or any private organization that will supervise the functioning of such credits. Terms of credits are flexible for the personal benefits of the lender and the pitiable conditions of the borrowers. The rate of interest is much higher than that of formal source of credit. We should always encourage formal source of credit for the development of the country. Children, do you know the reason why? Because number one, more lending would lead to higher income and encourage people to invest in agriculture, which in turn will encourage in business and setting up small industries. Number two, cheap credit will enable more investment and this will automatically accelerate the economic activities. Number three, cheap credit would also allow weaker sections of the society to access formal sectors of lending and get rid of informal money lenders. Cheap credit will also end the cycle of debt trap. Cheap and easy terms of credit would inspire better investment in technology and that increase competition. But still, why do people prefer to go to money lenders than banks for a loan? Well, the reason is very simple. They do not need any documentation while taking a loan from informal sources, such informal sources. Second thing, no collateral is required while taking a loan from the money lenders. And the third thing, very few banks are found in the rural areas. So if a farmer needs loan urgently, he'll find it very difficult to go to a bank because he has to travel such a long distance. So in such a scenario, he will always prefer to go to a money lender who stays near his house and borrow the amount he wants. So because of these reasons, even though formal source of credit is much safer and the rate of interest is much lesser than informal source of credit, the farmers or the weaker section of the society prefers to take loans from the money lenders. Now the next one is cooperative loans. Cooperative societies are small organizations formed by the people themselves or the people belonging to the same community. The members of this cooperative society pools their resources in the account for the cooperative and then extends loans to those who are in need. Cooperatives also takes loans from the bank. There are several types of cooperatives like Kisan Cooperative Society, Weavers Cooperative Society, Industrial Workers Cooperative Society, etc. Look at the last concept in this chapter. That is the self-help group. What is the self-help group or SHG? Well, the self-help group is an innovative way to organize rural and urban poor, particularly women. What are the features of the self-help group? Number one, it is a group of 15 to 20 members belonging to one neighborhood. They meet and pool the savings regularly, and the savings per member may vary depending on the capacity of the members. Number two, the group advances loans to its member at a very nominal interest without any collateral. Number three, most of the important decisions regarding the savings and loan activities are taken by the group members themselves. The group decides whether the loan should be granted, how the payment should be made, and at what interest. It is the group that is responsible for repaying the loan. In case of non-repayment by any members, all the members seriously follow up the repayment. The regular meeting of the group provides a platform to discuss and act on varieties of social issues such as health, nutrition, domestic violence, etc. Now, what is the advantage of such group, children? Number one, these groups help the poor, in particular women, to get organized to handle the money, collect and sanction loan. They make the woman very financially independent. This group creates self-employment opportunities for the members and that save the poor from the clutches of the moneylenders. The last one is the Grameen Bank. This bank was started in Bangladesh in the year 1970. This was formed by Professor Muhammad Yunus, who was awarded the Nobel Prize winner in the year 2006. This bank basically concentrates in giving loans to women's borrowers and that helps in the uplifting of the women in Bangladesh. Well, children, we have come to the end of this chapter. Hope you have understood all the concepts related to money and credit, and hope this was very informative and this will help you in the preparation of your board exam in the month of March. Thank you for listening to my video. I'll be back again with another chapter. Till then, take care. Bye now.